Welcome to the June 2020 Quarterly Investment Update. The June quarter was one of surprisingly strong market returns. For example, Australian equities were up 17% and US equities were up 8.5% for the quarter. A typically diversified growth index fund returned 9.3% for the quarter. And over the 12 months to 30 June, we've ended up better than expected, with Australian and international bonds up 4 to 5% for the year, Australian shares down 7% for the year, but US shares up 8.5% for the year. A typical diversified growth index portfolio was flat at 0.6% for the 12 months. So what drove these returns for the quarter? Well, firstly, we made progress in suppressing COVID-19, at least initially during the quarter. Secondly, global central banks reduced interest rates, which supported both economic activity and share prices. Global governments also supported individual and businesses via subsidies and tax breaks, and banks were supportive of personal and business borrowers by allowing deferral of loan repayments. Also, many tech companies like Apple, Zoom, and Amazon actually benefited from the increased movement of communication and commerce online due to the COVID-19 restrictions. So what lies ahead? The path forward is incredibly hard to predict in terms of how large and prolonged the first, second, and possible third wave of COVID-19 will be, whether we'll be successful in developing a vaccine, the timing and quantity of government support, both extension of existing support and then its withdrawal, but also it's very hard to determine how much of the damage to personal and business wealth is being hidden by the government stimulus, and how this will play out in the longer term as COVID restrictions are removed. Also, how are the investment markets valued at the moment? Well, on a 10-year basis, we consider growth assets to be good value compared to defensive assets. To this end, we think growth assets, like Australian shares, international shares, and property, are expected to return about 6 to 10% per annum over the next 10 years. And this compares to expected bond returns of only 1 to 2% per annum. So what are we doing with portfolios? Given the recovery in markets in the June quarter and the possibility of future weakness in a downside scenario, we're rebalancing retirement portfolios to ensure they have sufficient liquid assets to ride out a second and possibly more prolonged fall in markets should that eventuate. Other than rebalancing for liquidity, however, we are maintaining portfolios at or around their long-term benchmarks, given the current favourable long-term valuations and the risk that trying to time market exit and entry almost always results in a worse long-term outcome than just staying invested. And finally, for new money, we see that the short-term environment is one of heightened uncertainty, and so we're cautious about investing new money at this time. I hope you've enjoyed this quarterly update. Please contact Stella or I should you wish to discuss this update or discuss your portfolio in particular. See you next time.